All right, so just a lot going on in the world, Amy. There's a lot going on. Government shutdown. We mentioned tariffs and everything else. But the VIX has really been kind of muted. It's been muted like well below the highs of earlier this year when we first got those tariff announcements. So I want to ask you, when in the options market, isn't just the play to own the VIX, whether it's calls or puts or inverse? I mean, isn't that the place to be? Because what are the chances the volatility stays the same going forward?
It's such a great question, Frank. And I think for a cohort of people that is the answer. But unfortunately, and I've brought this analogy back before, the market's been a little bit like a paddling duck, meaning that duck looks calm and smooth on the surface, but those little duck feet have been violently paddling underneath. And essentially what is happening is there are moves under the surface, but they've had this effect of canceling each other out. So when you feed back into the VIX, you don't see it as much. But, as we continue to climb to highs and we keep getting less and less data, there's a lot of angst that I would say is also riding under that surface.
All right, so let's just kind of pull on this thread about VIX options right now. Do you pay more for the upside, the downside, the inverse? I mean, where do you have to pay more? Where's the money going right now?
So it's really interesting. I'd say historically, if you look back 20, 30 years, it's always the downside, right? Because people are long the stock market, and what they want is insurance. They want to hedge their portfolios. I'd say a post-COVID phenomenon, Frank, is this idea that the right tail, so the upside, is what people are really concerned about, because they're much more concerned about, AMD coming out with news or OpenAI coming out with news and something ripping that they are not participating in. So the FOMO's really got people. You actually have much more concern about folks missing out than they have about the market trading down. And so we've seen a lot more call options trade in things like NASDAQ or S&P or on individual stocks as well.
All right. What individual stocks, though? I mean, when we're seeing the options action, is it investors trying to play the upside on some of these AI names, or actually thinking that there may be a bit of a top happening here? We just heard from Paul Tudor Jones yesterday, kind of worrying about just this market and the rally and kind of what do you call it, a blow off?
Yeah, so I would say especially we're a little far out in terms of tech earnings, so that doesn't happen quite yet. It's going to be financials first. But what we've seen in previous quarters is when you look at the Mag 7 and AI tech names, they start to get really inverted from a call perspective. All that means is people are really bidding up those call options. Again, they don't want to have the FOMO. They don't want to miss out when these are such heavy concentration names in the benchmark. We are not seeing that yet. We're also not seeing, demand for downside, but I would expect that to pick up as we get closer to their actual earnings dates. All
right. What do you see when it comes to financials? And does the shutdown have an impact, at least for the options market, when it comes to financials and how investors view them?
So far, I think we're about a week into the shutdown. You haven't seen pricing tick up yet, either in financials or on the broader market. Now, I would expect this to change. So right now, the options market is pricing that we will get some sort of resolution before the Fed has to have its next meeting. If we're not going to see that, Frank, I do expect you're going to get that VIX headline number higher. I do expect that people are going to start reaching for protection because now, talk about flying blind. It's going to be a few more days of that. Financials, typically, when you look at proxy ETFs, like KRE or XLF, it's a good time to own that volatility either through calls or puts, because that tends to be when the most idiosyncratic single stock volatility occurs.